Welcome to the Business and Finance Symposium, to the session on international tax. We are going to be covering some current and forthcoming national and international tax changes. We'll start with talking about the U.S. withholding on payments to foreign persons. Then we're going to get into GILTI and FDII, two acronyms that we've gotten very used to post 2017. We will then discuss implications of having a global workforce, a lot of risks and a lot of opportunities. Finally, we'll get into OECD Pillar 2, a really brief discussion about that could have some big tax implications.
So the first topic that we're going to talk about is withholding on payments to foreign persons. And as some background to this, uh, U.S. payors, the U.S. person making the payment to a foreign person, uh, they're known as withholding agents, and they're required to withhold and remit withholding taxes on certain U.S. source payments. And it includes payments that, such as dividends, interest, royalties, rent, etc. Certain those types of payments. And the general withholding rate on these types of payments is 30% of the gross amount of the payment, unless a reduced rate under an applicable U.S. tax treaty is claimed by the foreign payee. And where a reduced rate is claimed by the under a treaty by a payee, the withholding agent has to collect and review supporting documentation to just make sure that they do their due diligence around that claim and that the withholding documentation is correct. The withheld taxes have to be deposited with the IRS on a timely basis. That's something that we run into once in a while when we talk to a client, they say, yes, we've done the withholding, but then they forget to deposit it with the IRS on time. And that could lead to penalties on those late payments. And one of the key things is that why is withholding important to you? It's that a withholding agent, it's liable for any under withheld amounts. So as the withholding agent, if any if there's any under withholding of taxes on that payment to a foreign person, you are liable for it for the entire amount. Can you go to the next slide? And what I touched on before, some of the withholding documentation, how the withholding agent has to collect reliable documentation to support the foreign payee's claim for the reduced rate under an applicable tax treaty. That's generally the form W8 Ben or W8 Ben E. There's a whole series of W8 forms, but those are the most common ones that we see as far as the types of payments made to foreign persons. So these forms should be collected from the foreign payees before making the payment. And then once you receive those forms, there is some level of due diligence that should be done on those forms just to make sure that it's filled out completely and that it's reasonable. Just for example, just recently we received a number of W8s, questions from a client, and then around W8s, and they provided us with the W8s that they received just to take a look at them. And one of the W8s was a payee from the UAE claiming a reduced treaty rate. And the thing about that is that there is no U.S. tax treaty with the UAE, so it's not possible for them to claim a reduced treaty rate under a treaty between the U.S. and the UAE. So it's things like that that you have to review the documentation for and just make sure it's reasonable. Also, a withholding agent has to file forms at the end of the year, the 1042 forms, 1042, 1042S, to provide that to the foreign payee to document the amounts that were withheld on their behalf on any of these payments.
So Calvin, should U.S. payors be looking at this as the flip side to collecting W-9s and issuing 1099s to U.S. people?
Yeah, it's the same idea, just to make sure that you have the withholding correct, you know who you're paying, and you have that rate that you're withholding on correct.
And I think to add to your question, Manpreet, We see very often that companies have policies in place in their accounts payable process where they won't issue a payment until they have a W-9 from the payee. And what we'd like to recommend to our clients is don't issue payments until you have a W-9 or a W-8, because where it's foreign, very often the accounts payable department just doesn't do anything. But we do recommend, and we'll talk about some of the situations we've seen and we've been brought in to help out with, where payments that maybe people thought shouldn't have been withheld upon were subject to withholding. So definitely the starting point is, collecting those, like the same way you're collecting W-9s from your domestic payees, you should be collecting W-8s. So you should have one or the other, but
Right.
you shouldn't have a situation where you don't have either.
Right. And if you don't get that W-8, if they refuse to give it to you, your stick is that 30% withholding is required if you don't have the documentation. So, you can tell the client, fine, don't give us the W-8, we'll just withhold 30%. And finally, you can keep those W-8s for 3 years. So after 3 years, you should get a new one.
Yeah, thank you. The the next slide covers the kind of like the thought process around any payments you make to a foreign person, things to think about uh, to determine whether withholding is applicable, and then what rate should be used. It's first you have to determine what the U.S. tax characterization of that payment being made is, because sometimes between the between the business side and the tax side, the terminology is different as far as what they're calling certain payments. So it's important to take a look at the actual payment to determine for tax purposes what is that character of that payment. Is it a royalty, or is it something else? Uh, the next question to ask yourself in the process is whether it's a U.S. source payment, because if it's a U.S. source payment, then it's subject to withholding, and if it's non-U.S. or foreign source payment, then it's generally not subject to the U.S. tax withholding. And then you go down the list, and then you have to determine whether the foreign payee is claiming a reduced rate of withholding, and if they provide the correct documentation to support that claim. So that's sort of that's the same considerations that Kimberlee and Chaya and Manpreet mentioned before, that collecting that W-8, making sure, doing some due diligence around that W-8 to make sure it's complete and reasonable in their claim, and then keeping that on file. And then the last question is, when does the withheld amount have to be deposited with the IRS? And under those rules, it's generally based on the size of the withheld amount. So larger amounts have to be deposited sooner with the IRS, and where smaller amounts may, if it's small enough, it can be paid with the 1042 filing at the end of the year. So when thinking about withholding and just making sure that you're withholding correctly, those are the main questions that you want to think about, at least on a threshold level.
Great. Thanks, Calvin, for that background. I just wanted to chime in with a couple of recent, you know, real life stories that we've seen, just to bring home the importance of thinking about this and considering it. So, a little over a year ago, a company reached out to us because they were under audit from the IRS. And what was interesting about this audit was it was a 1042 standalone audit. So 1042 is that form that you file when you've withheld and you have to, or you have made a payment of U.S. source income that is potentially subject to withholding. And the IRS was auditing their 1042. There was an initial assessment of, I want to say, between $400,000 and $450,000 roughly. And so the company reached out to us to see if we can help them walk through this audit process. Now, what's interesting is um, standalone 1042 audits were not something that we had seen a lot of in the past, or any actually. So it's the first time, and we have been hearing the IRS talk about that this is something that they want to look into. So we're actually now seeing it in practice. Um, and at issue, the IRS this particular taxpayer had several hundred recipients, so it was making payments to several hundred foreign parties, and the IRS requested to see the documentation, so the W-8s, which typically the taxpayer collects from the foreign payee and then holds on to it. It's not something that you submit to the IRS unless they audit and request it. And so the IRS requested the W-8s, and they reviewed all of the W-8s in great detail, and determined that although the nature of the income, there was a treaty provision or some other exception where there should not have been withholding, but because the W-8s were not complete, they were either missing information, or there's, for companies in the financial sector, there's a global ID number that they need to apply for with the IRS, and it expires and it has to be renewed. And so that global ID number, the GIN number, was not current at the time that the W-8 was completed. The IRS assessed a tax liability against this company that became our client, um, because, as Calvin mentioned, if you are required to withhold and you don't withhold, then the company that's required to withhold, or the U.S. withholding agent, becomes liable for the actual 30% tax. And that means either if the tax should have been withheld, or if better documentation should have been obtained. And in this case, it was the latter, meaning had the proper documentation been obtained, there would not have been withholding, and everyone would have, gone on their merry way. Unfortunately, in this case, we were able to remedy some of the issues, chase down, do some research. We were able to bring down the tax assessed by about $300,000, but the taxpayer was left paying the IRS, upwards of $100,000, simply because they did not have the proper documentation on hand at the time that they made the payment. So just to underscore the importance of, if you're in a situation where you need to withhold, you're making payments to foreign persons, just cleaning up house and making sure you're getting all the documentation, because the IRS can look at it. And even if you've never filed a 1042 under a income tax audit, they may request a list of vendors that you've paid or payments that you've made, and so it can come up then. So it's definitely something the IRS is thinking about. It's definitely something that, as taxpayers, we should pay attention to, because we definitely don't want to be left holding the bag and having to be paying that 30% tax. One other quick incident to also underscore a point that Calvin made, which is another fact pattern we ran into recently. A client reached out. They had this payment that they were making to a foreign partner, and I'll say partner in quotes because they called this foreign party a partner, but from a tax perspective, there was no tax partnership. It was a partner in going to market in that sense, but in the sense of a tax perspective, it was not a partner. And so we have to take a look and understand the nature of the payment and whether or not it was subject to withholding. And in that instance, it was, with a potential reduction under the treaty. So what came in as like an innocent question, I think the client was expecting that they wouldn't have to deal with it because, oh, it's just a partner, it's a company we do business with. Bottom line, if you're making a payment of anything to a foreign person, you should make sure you're clear that there is no withholding, because again, the stakes are high here.
Okay, we're going to move on to the global intangible low-taxed income and foreign-derived intangible income, and I will hand this over to Calvin and Manpreet this time.
Thank you, Kimberlee. So we're going to just talk about GILTI and FDII, and then some of the proposed changes that are the upcoming changes that have been proposed. So a lot of people should probably be familiar with these terms, but if not, just we just wanted to cover these two tax regimes and benefits on from the international side uh, pretty quickly. So GILTI and FDII, they were introduced in the 2017 Tax Cuts and Jobs Act, where the GILTI regime requires a current inclusion of earnings from certain foreign corporations on an annual basis as deemed distribution. And this was aimed at concern over taxpayers shifting earnings to foreign low tax jurisdictions so that they implemented this broad anti-deferral regime. So under the GILTI rules, U.S. corporations are subject to an effective tax rate of 10.5% on these inclusions of incomes from foreign corporations. And that's achieved through a 50% deduction uh, of the GILTI inclusion amount. So for tax years beginning December 31st, 2025, that 50% deduction will be reduced. So it will result in an effective tax rate that will increase to 13.125%. In addition, U.S. corporations are able to claim a foreign tax 80% of their foreign tax credits against their GILTI liability. So when you do the math, where the current with the current rules, if the foreign tax rate that the foreign corporation is subject to is greater than 13.125%, then that taxpayer should theoretically be able to fully offset their GILTI liability with foreign tax credits.
And I guess, even just to take a step back, Calvin, just think about GILTI and kind of what it does, right? So, I think a common fact pattern is, you have a US C Corp, 100% owned subsidiary in some non-US jurisdiction that's, selling goods or services within that jurisdiction alone, right? So prior to 2017, that income probably wasn't subject to U.S. taxation, right? Because if it was contained within the same country, probably wasn't subject to our Subpart F rules. So, that income was only taxed upon actual repatriation. Post 2017, now it's being taxed on an ongoing basis, even active income, right, of these controlled foreign corporations. So it's a major shift in the way the U.S. Taxes overseas subsidiaries. I think it's viewed as a modified territorial system. So it's become pertinent for all U.S. taxpayers with non-U.S. subsidiaries, whether it's a U.S. C corp or just an individual that owns shares of a non-U.S. company. So it's become increasingly important, as Calvin highlighted. There's different tax rates and deductions available depending on the type of U.S. taxpayer you are. But this topic has basically become relevant for just about all U.S. shareholders that own shares in a controlled foreign corporation.
Yeah, thanks, Manpreet. So the next topic is FDII, Foreign-Derived Intangible Income. So unlike GILTI, which is a additional tax inclusion for U.S. taxpayers, FDII it's a benefit for U.S. taxpayers. Um, and that was also introduced in the Tax Cuts and Jobs Act of 2017, where it provided a 37.5% deduction on FDII eligible income for U.S. corporations selling goods, licensing IP, or providing services to foreign customers. And the FDII deduction, the effective tax rate on FDII eligible income is 13.125%. However, that FDII deduction, similar to the GILTI rules, at the end of 2025, December 31st, 2025, that the FDII deduction will be reduced from 37.5% to 21.875%. So that increases the ETR on FDII eligible income from 13.125% to 16.4%. And as far as qualifying, certain that income that the income or sales that qualify for the FDII deduction, there's fairly complex rules around those types of sales and what qualifies. So although it's some, we would highly recommend analysis around that to just confirm that your business, if you are claiming FDII, just to confirm that you qualify for that deduction before taking that deduction. And then also the documentation requirements, those must be, you must have the documentation in place, whether it's invoices and other types of documentation generated in the ordinary course of business. It has to be kept on file and be in place by the tax return filing deadline. So you can't file the return, claim FDII, and then get your books in order to collect the documentation just to support taking the deduction afterwards.
That's right. And I guess, Calvin, the way I look at FDII, it's a another export incentive, right, in our tax code, similar to the IC disc. And both of these regimes, the IC disc and FDII, you can utilize both of them concurrently. So if you have an IC disc, FDII is absolutely something you should be looking at. Um, but I'll also say, like, while the rules are complex, this tax benefit is available in a wider variety of places than may seem obvious, right? So one thing that is interesting about FDII is the goods don't necessarily have to be originating from the U.S., right? So if you're dealing with like commodities, uh, that's an interesting place I've seen FDII come up and be utilized, right? So think of precious metals being delivered outside the U.S. So it's not always obvious where this benefit may be available, which is why it's important to kind of talk to your tax advisor, talk to us about this, and really understanding kind of your service supply chain and where you're delivering goods or services. But it's a benefit that can lead to, again, if you have, we have some clients with all of their sales are to foreign customers, right? So you look at their corporate tax return, their ETR is that 13.125%. So it can lead to some serious tax savings. Um, and also, Calvin, as you pointed out, like the documentation can be a bit burdensome, but it's really just creating an audit defense file, really proving and showing that your customers are foreign people, and if you're selling goods that they're actually landing in foreign jurisdictions and not coming back to the U.S.
Yeah, yeah, and it's important to note here that the FDII deduction is only C corporation, only corporate U.S. corporations are eligible to claim the FDII deduction. Whereas, like you mentioned, the IC disc before, I think like an S corp can set up an IC disc, so that's not limited to corporations that that benefit. And then also you also just mentioned that as far as the FDII deduction, there's no requirement for the goods or product to be manufactured or created in the US, that it could be something as simple as, we buy, widgets from another country, import them here, and then we sell them again to foreign customers. Whereas I believe the IC disc, that requires the goods to be manufactured here in the US. So those are general, basics about GILTI and FDII. And then now we're going to touch on some of the 2025 Green Book proposals. These are just the Biden administration's proposals to changes as far as the international tax rules that we just wanted to highlight here. Uh, so they proposed a increase of the corporate income tax rate from 21 to 28%, and they also proposed changes to align OECD Pillar 2 rules, which Chaya will touch on later in the presentation, to replace the BEAT tax here in the US with an under tax profits rule that disallows deductions to ensure a minimum effective tax rate of 15% in each jurisdiction where a multinational corporation has profits. Another proposal is to increase the GILTI effective tax rate to 20%, and that's in conjunction with the proposed increase to the corporate tax rate, but then they proposed to eliminate QBI, the qualified business asset investment amount, from the GILTI computation, and they also repeal the high tax exemption for GILTI. Another proposal is to reduce the 245A uh, dividends received deductions in certain situations for foreign sourced income of controlled foreign corporations. And then the last proposal in the international tax area is to replace the FDII deduction with R&D incentives instead. So where the FDII deduction, if that is repealed and it's not available anymore, then something to look into is whether an IC disc would be beneficial for you.
Okay, we're going to move on to the implications of having a global workforce. And Manpreet and I will cover this, but we're going to start with Manpreet.
Thank you, Kimberlee. So, the past 4 years, we've seen a seismic shift in the way, people work, where they work from. And so, along with this, there are tax implications, right? So, um, you know, most obviously, people have dealt with state income tax issues in terms of having an employer in one state and then being physically located in another. This is more of a cross-border, a similar effect in the cross-border context, right? So what we're looking at here is income tax related issues that could arise for the corporate employer, and then there's also individual income tax issues that arise for the individual at their employee level. So we'll start with the income tax considerations and looking at this on an inbound perspective, right? So you have foreign corporation with employees in the U.S. So in the U.S., foreign corporations are generally subject to tax on income effectively connected with their U.S. trade or business, or we call it ECI. And so what ECI requires, or what's required in order for a foreign corporation to be viewed as having ECI, is considerable, continuous, and regular contact with the U.S. For the purpose of earning a profit, right? So again, thinking of companies just selling goods into the U.S. As you'll notice here, there's no requirement to have a physical presence in the U.S. to be taxable, just that considerable, continuous, and regular contact. So just thinking about the income tax exposure first is important here before even getting to physical presence. So thinking about expansion, both inbound and outbound, usually effectuated through either a branch or a subsidiary. A branch isn't a defined term in the U.S. And usually isn't in non-U.S. jurisdictions, but a branch is essentially a business unit in that jurisdiction that's not operating within a legal form, and that legal form is a subsidiary. So whether you have a branch is a bit more gray, whereas a subsidiary is black and white, right? Either you've organized a legal entity or you haven't. So the branch inquiry is a bit more nuanced, and does one person give rise to a branch? Maybe not, but maybe, depending on what they do. But as you have more people in a jurisdiction, that group of people begins to resemble a branch. Go to the next slide. So why that is so important, particularly in the branch context, and why this concept of permanent establishment comes into play, is because when you have a permanent establishment, that's when you more clearly have a taxable presence, when you have a branch. So what exactly constitutes a permanent establishment? Again, this is another definition, I'll say, that varies by jurisdiction. And even in the US, it's not defined by statute. But looking at our model treaty, you see that it can be described as a fixed place of business that some portion of the business is conducted out of, right? So what can that mean? That can mean a variety of things. Most obviously, like an office, right, or a place of management. So thinking about that sort of presence, right? And that's probably the clearest example, but what becomes less clear is, again, just having a person in the jurisdiction, trying to generate sales. So permanent establishment is it's an unclear concept that requires analysis and is often your first inquiry in determining whether you have a taxable presence in either the U.S. or a non-U.S. jurisdiction. And so thinking through, again, that permanent establishment concept, from a U.S. point of view, as I said, a variety of things can give rise to a permanent establishment. But then you have the treaties, or tax treaties with various, non-U.S. jurisdictions that modify this definition. So, treaties will generally give a short list of things that are clearly a permanent establishment, and then a list of things that do not constitute a permanent establishment, right? So treaties function to limit the types of activities that are considered to give rise to a permanent establishment. So that makes you think, if there's no treaty in place, then all of those activities that don't create a PE under the treaty probably create a PE if you don't have treaty protection. So again, understanding whether or not you have a PE can become, a matter of both U.S. law, non-U.S. law, and then how the treaty interacts with that definition.
Right. And I just want to quickly point out that we do have one treaty. It's our treaty with Canada. It says that if you have someone in the other country performing services for more than 183 days, that creates a permanent establishment. So while that is only in the treaty between the US and Canada, it was part of the OECD base erosion profit shifting concept to start to include service PEs. So you'll find a lot of other jurisdictions will have that, and probably any renegotiated treaty will start to have the concept of a service PE come about. So when we talk about having a global workforce, having an employee sitting in another country might start to generate that PE that you would have or that another country would have in the US.
Exactly. And it's, thinking about that in the context of like the other country's domestic law, you might have a service PE triggered on day one. It's the treaty that will protect you up to day 180, right? So again, it becomes nuanced to really understand, what jurisdiction's point of view you're looking at it from, as well as whether a treaty can come into place to shield you from that permanent establishment finding. And the PE inquiry becomes quite important because most of our treaties have business profits articles, and these provisions will I don't want to say exempt, but you can take a treaty position that your profits generated in that jurisdiction aren't subject to tax because there's no PE, right? So a common example, a non-U.S. seller that has a warehouse in the U.S. Delivering goods out of that warehouse. The warehouse may or may not be considered a PE depending on the exact, PE article of that treaty.
Yep.
So that will drive whether or not a business profits position can be taken. So yeah.
Yeah, but what's also important to remember is you might be able to get out of being taxed at the federal level on your profits because you don't have a PE, but the states don't need to follow our treaties. So you could end up with a warehouse in a state, and you can be exempt from federal taxation under the treaty, but you'll be subject to the state tax.
Exactly. Depending on whether the state starts a federal income or has some other starting point and their own state rules. So it's quite nuanced, and it all these concepts of like income tax, permanent establishment, treaties, they all work alongside each other. So it's important to analyze them in conjunction. So from there, we'll move on to U.S. disclosures. We could have listed out the variety of forms that come up in this context, and the list will be quite long. A fair way to look at it is if you're a U.S. taxpayer, whether you're a U.S. person, company, partnership, or a foreign company with a presence in the U.S., there's just very far-reaching information reporting requirements. So it's not just items that give rise to income that's taxable. It's just information reporting. So just simply owning shares in a non-U.S. company, right, can give rise to reporting. So really looking at it in the context of cross-border transactions is probably a better way to think about U.S. tax information reporting disclosures, because it's not necessarily just reporting, again, activity that gives rise to taxable income in the U.S. It's really can be very transactional, like even contributing cash to a non-U.S. company in a 351 transaction, right? So it becomes a bit transactional, and the penalties for all of these forms and reporting requirements are quite substantial. So it's important to pay attention to. And the last topic here is indirect taxes. Again, in the U.S., think of sales tax, use tax, all of those, indirect taxes. Outside the U.S., it's VAT. So you may not have a taxable presence, an income taxable presence, in a certain non-U.S. jurisdiction, but you might have some sort of VAT collection obligation and filing. So indirect taxes should also be considered in this global context.
Right. And just because you might not have that rise to the level of permanent establishment, many countries will say when you have an employee working here, you're now going to be subject to the VAT requirements, whether it's VAT or GST if you're up in Canada. So you need to be careful there. So Manpreet has covered all of kind of the corporate things you need to think about when I think during COVID, some companies all of a sudden found out that their employee was working in Portugal, and what exposure does that bring? So you need to really know that. Now I'm going to get a little bit more into the payroll side and the personal side of that. So this is often when you decide to send an employee abroad, or the employee works with you before they actually move to Portugal, and some of the things you need to think about. And the first one deals with the social insurance taxes or social security. The US has about 30 totalization agreements with our major trading parties where, if you are a US person and you go work abroad, mostly for an affiliate company, are you going to be subject to Social Security in both countries? Or if you start to be subject to Social Security in the host country, what happens when you retire and you might lose, not have income, or you'll have income earned in both countries, but does that does that get you up to the level where you actually get benefits? So it works both on the tax side and on the benefit side between this totalization agreement, eliminating the dual taxation and protecting the benefits of workers. Again, I said 30 countries. It's mostly all in Europe, but we do have a few in Asia, Japan and Korea. We do have Canada, one of our biggest trading partners, Australia, and then 3 countries in Central and South America, Brazil, Uruguay, and Chile. Interestingly, not in Mexico. I thought we had one in Mexico, but we don't. If you are self-employed and you decide you are going to move to a foreign country, you can, as a U.S. person, be considered the employer and get protection under the totalization agreement. Generally, what happens if you are hired by your home country and you move to a host country and you're there for less than 5 years, you can remain on U.S. Social Security even though you are living and working in a host country. You're still going to be subject to income tax in that host country, but you can stay on your U.S. Social Security. Makes things easier in the long run. And P.S., if you're covered by Social Security in the U.S., you can also participate in your employer's retirement plan, like their 401k plan, instead of having to participate in a foreign country's retirement plan. Italy is an exception. Italy does not have that 5-year limit. You can go to Italy for as long as you want and stay on U.S. Social Security. To make sure that both countries know where you're going to be taxed, there's a program of certificates of coverage. Usually the employee, but often the employer can apply on the employee's behalf, applies for a certificate of coverage saying we're going to keep this employee on our home country Social Security or social insurance program. In the US, you can apply online. It's a fairly easy application process. And knowing that it might take time to actually get the certificate, you can go abroad and claim to be covered under the certificate of coverage to be given at a later date. So it's something that needs a little bit of pre-planning, but not a lot of pre-planning. And it's a really good way to help manage both your employees' benefits over the long term and your costs. Because believe it or not, US Social Security tends to be a lower cost to the employer than a lot of our totalization agreement partners. So once you've decided you're going to send an employee abroad or an employee decides to move abroad, how do you handle their payroll issues? So, Manpreet talked about all the issues that an employer might face. Do I have a permanent establishment in a foreign country? Am I going to be subject to income tax? And even if I'm not subject to income tax, am I going to be subject to reporting requirements? Well, to handle the payroll, you may not want to get on record with a foreign jurisdiction that you're there with an employee. Often you can go, if you have an affiliate, you'll put the employee on the affiliate's payroll. But if you don't yet have an affiliate, what can you do? You can use an employer of record. I've listed 2 companies that we have worked with, Global Pay and HLB Ignite, that will handle the payroll process for you. But just because you use an employee of record or a PEO does not mean you don't have all of those issues that Manpreet just talked about, that you haven't established that you haven't created a permanent establishment, that you're not subject to income tax and other reporting. So um, you can go ahead and get your company registered and work through us and through our affiliates overseas to actually perform that payroll responsibilities for income tax. But you can also use a payroll of record. Some other issues you'll need to address as you think about sending your employee overseas. One is that they need to probably get healthcare and insurance coverage. If they go to the UK, they can stay on US Social Security, which is great, but if they do, they're not covered by national health in the UK. So you may need to get a worldwide healthcare plan to cover them. You'll also need to think about what retirement plans they can participate in. If they go for more than 5 years and can't be covered under the totalization agreement, they will lose their ability to participate in a US retirement plan. So what kind of retirement are we going to offer? Finally, it can be very expensive for an employee to move to a jurisdiction, especially if that jurisdiction has a higher tax rate than the US. And so many companies will look into offering tax equalization, which basically looks at what were you earning in the US and what was your net take-home pay versus what are you earning abroad, and let's get you to about that same take-home pay, knowing that you're going to be paid, you might be paid a cost of living adjustment, you might be getting help with your rent, you might be getting help with your tuition. If you have kids, you might be getting help with home leave. All of that is taxable income in the US. Might not be taxable income in the host jurisdiction, but it is here. And then here we also have various, I think this might be on the next page, we have uh, various things to eliminate the dual taxation. For example, the foreign earned income exclusion and foreign tax credits. So tax equalization looks to put your employee in the same level of kind of disposable income as they were before they left the US. Tax protection basically says you won't pay more tax than you paid in the US, because sometimes you'll send a client or an employee to a jurisdiction where there's a lower tax rate. And so you don't give the employee the benefit of the tax equalization, you just protect them. So when US citizens work abroad, and the employee needs to think about this, there are other things other than payroll and Social Security. Most of the time, if you're being moved over by a company, they'll help you get that working visa to work in the foreign jurisdiction. Many countries, as part of COVID and post-COVID, have what they call digital nomads. And countries have said, basically, if you continue to work for your home country employer, you can come to our country, get a working visa to work here as a digital nomad, and we will kind of keep our hands off of you. We won't subject you to the host country payroll taxes or income taxes. So those visas are still available in certain jurisdictions to entice people to come in. I briefly mentioned, if you're a US citizen working abroad, there are ways to reduce your US taxation. There is a foreign earned income exclusion. If you have a tax home in a foreign jurisdiction and you meet one of 2 tests, you can actually exclude a chunk of your income from US taxation right off the top. Anything that is not excluded, you can get a foreign tax credit if you're paying tax in that foreign jurisdiction. Keep in mind, unlike the rest of the world, US citizens and lawful permanent residents, green card holders, are required to report their worldwide income to the IRS every year, regardless of where they live. If you have employees that are coming from a foreign jurisdiction, most likely they will cease to be tax residents of their home jurisdiction, and they'll only be subject to US tax. When we have U.S. non-residents that come into the U.S., the first year that they're here, they need to meet the physical presence test. It's a test of how many days they're spending here, but once they've met that, they are a U.S. tax resident. In that first year, they can be a dual status, which means part of the year they're a non-resident and part of the year they're a U.S. resident. Also, if they come over and they're married, they can claim to be a tax resident of the U.S. for the entire year and still claim those foreign earned income exclusions. But that will often help an employee who's married pay lower tax in the US, because if you come in your dual status, you have to file married filings separately, which tends to be lower deductions and higher tax rates. Also, finally, quickly, there are specific treaty protections if they're coming from a treaty country where students and teachers can get special exemptions to not be taxed in the home jurisdiction, often for a limited period of time. Students coming in on a student visa can be exempt from Social Security on work that's done, but that visa that they have to be working in their area of study. So there are a few things. Artists and athletes kind of fall outside of this because they, if you are, if you're good to expand, if you're Taylor Swift and you're going to go do 3 concerts in Austria, Austria is going to tax you on that income. So the treaties don't let you get away with not paying tax, not saying I don't have a permanent establishment, not saying I'm not here long enough. You're going to pay tax. Finally, and this is a big one, treaties also provide residency protection. We have closer connection tests that say even though you might be physically present in the US, if you retain closer connections to your home jurisdictions and you're a tax resident there, you can be taxed in the US as a non-resident despite meeting the substantial presence test. That's a lot to get through, but I'm going to, call us with any questions. Hopefully you don't get a call from an employee say, hey, I'm now working from Andorra. So when that happens, you want to be careful that we go through all of the issues. I'm now going to turn it over to Chaya, who is going to cover OECD Pillar 2.
So this is an interesting topic. It really applies or most impacts currently the really large multinational enterprises. But a lot of the changes that OECD, the two-pillar solution, a lot of the ideas that are in those documents, we are seeing filter down and being relevant to smaller companies. So that's why we think it's important to talk about this. If you're doing business cross-border, even if you're not a giant multinational, it's becoming more and more likely that you will run into a Pillar 2 related, issue or question. So let's take a step back. What is this two-pillar solution? The OECD, which is a global think tank, it's a tax think tank. It's comprised of, I think it's 100 in the 150 country. There are members, representatives from each of the member countries, and they sit together and they talk about tax issues. And so what they decided about, 10 or 15 years ago, it's closer to 15 years ago now, is that it's time to rewrite the tax code, because when you look at international tax, what the questions that international tax are addressing are who does, when you're dealing with a company that's multinational, who has the right to tax this multinational, and on what amount of income can that tax authority tax the multinational. And so in a world where everything is brick and mortar, if you want to do business, you have to be in the neighborhood. Those issues are not as challenging because we know clearly where you are physically, and we see where your income is coming from and how much income is coming from there. And that's the tax code, pre-pillar 2 modifications or the two-pillar solution modifications really was based on those kind of ideas where, brick and mortar, and didn't take into consideration, say, like a Netflix or digital services, digital products that people are able to sell, where you can be streaming, let's say Netflix can be streaming $20 million of content into France and not have any physical presence there. And that means that France doesn't get to tax it based on old rules. So one of the issues that, Pillar 1 in particular is looking to address is how do we tax digital services and digital products, and they're not answering that question directly, but we'll talk about what Pillar 1 does. But that's kind of the issue Pillar 1 pretty much looks at, which is digital taxes and taxing of digital transactions. The other issue in a digital world is the ability to more easily shift revenue. So if you're living in a world, 30, 40 years ago, if you were doing business, your customer was in your neighborhood for the most part, or you had a presence within some kind of regional area of your customers. Today, you can have customers on the other side of the world because everything's done digitally and there's not an issue. And this kind of ties into, what Kimberlee and Manpreet were talking about, your digital nomads and your global workforce. That's the reality. And so companies can take advantage of that and try to shift their income into a lower tax jurisdiction globally so that they're not paying that much tax globally. And so there was concern around that and abuse of that, where companies would just be shifting assets and trying to shift profits that way. And so Pillar 2, which is the one that is more imminent, addresses this by implementing what's essentially a global minimum tax. So even if you successfully manage to migrate your assets so that you've migrated the income associated with it to a no tax jurisdiction or a very low tax jurisdiction, now the parent company or some other company within the group with a Pillar 2, some kind of Pillar 2 related provision in place, is going to be able to implement a global minimum tax. So you kind of lose the benefit of shifting your assets and shifting your income, because there's going to be a global minimum tax. So you're going to pay a 15% tax on your income. Doesn't matter where in the globe it's implemented. It's being generated. So again, Pillar 1, just a summary. And Pillar 1 so Pillar 1 is the digital services tax, or the digital taxes, and that Pillar 1 kind of tackles that with addressing transfer pricing and how we look at allocating profit of a multinational, where again in the past it may have been tied into like assets and risks and functions, and some of those functions, assets being very physical in nature. This new way of allocating profit also looks at your market. So if your market for Netflix is in France, for instance, we're going to be able to tax you in France. So that's kind of an asset that we now have to consider also, market. So it's market-based taxing. And then the Pillar 2, which is the global minimum tax that we had spoken about. So a couple of other notes. Pillar 1, it's probably a little bit more down the road. It would apply to multinational enterprises that have 20 billion euro in revenue, 20 billion or more in revenue. So not going to apply again on the face of it to the smaller companies, but the concepts that are baked into Pillar 1, those are going to start filtering into the various transfer pricing rules and regulations and just how countries are implementing transfer pricing. So something to keep in mind and to think about from a transfer pricing perspective. And then looking at Pillar 2, so final document on Pillar 2 came out in October of 2023. It's already enforced in many, many jurisdictions. The US does not currently have a Pillar 2 type tax in place. The common one, the qualified, the QMDTT, but the minimum tax in place. Perhaps the CAMT, the regs around CAMT are trying to match up to that Pillar 2, so that it could be it could be considered a Pillar 2 tax, because that would be important for large multinationals. Again, this only will apply to companies with 750 million or more euro in revenue. But we are seeing countries like Australia are implementing something, a Pillar 2 type tax at a much lower threshold. So it's important to be aware of it and be having the conversations. The large multinationals who meet that threshold, they've been assessing their structures, they're getting ready to implement, updating the technology, understanding things. For the companies that don't hit that threshold, the key right now is staying informed, being aware what's out there. If you are entering a new jurisdiction, or if you're operating, you have a significant presence in a foreign country, having a conversation with your tax advisors and understanding, well, what is the outlook look like for Pillar 2 implementation? How might it affect you? And things along those lines. Not necessarily a big imminent issue, but definitely something to kind of keep your finger on the pulse around.
Well, thank you for joining us. And if you have any questions, please reach out. We're happy to work with you on any of your international tax needs.